March Fed meeting minutes showed officials are ready to shrink assets and move faster on interest rates, but will their plan do enough to cool red-hot inflation? Joining me now, Philadelphia Federal Reserve Bank President and CEO Patrick Harker. President Harker, thanks so much for coming on the show. Really appreciate it.
Thanks, Jack, for having me.
So you and many of your colleagues have acknowledged that the Fed got caught a little bit behind the curve on inflation. Now you're taking serious action. Is it possible to handicap for the audience how high you think rates have to go? And can you raise rates, and this is the age-old question, I realize, without causing a recession? The historical precedent is not great on that score. How do you thread that needle?
So I can only speak for myself, not for the whole committee. Where I am is I think we need to raise rates methodically and do that in a way that gets us to neutral. And that, for me, is about 2.5%. Because two things are going on at the same time. We're raising the Fed funds rate, but I also am supportive of starting sooner rather than later the normalization of our balance sheet. That is the shrinkage of our balance sheet. That also removes accommodation from the market. So those two things, raising rates and removing accommodation by shrinking the balance sheet, I believe we can get inflation under control. We may not have a completely soft landing. It may be bumpy along the way with things like China opening and closing because of the tragedy of the coronavirus and, of course, the incredible tragedy of Ukraine. But we'll get down safely. It'll be a little turbulent, but I think we can get down safely.
Let me follow up a little bit on that point about reducing the balance sheet, because this is an area where there is less historical precedent. You know, you haven't been in this situation that often in the past. Is there an equivalency between QT by X amount equals a half-point rate hike or whatever? And how do you think the economy will respond to that?
So estimates vary a lot there because, as you said, we haven't done it very often. And so, rough estimates are all over the map. And so it's hard to pinpoint an exact number, but it's clear that that will remove accommodation. So I think what we need to do is start that process and be methodical about reducing the balance sheet. I'm in favor of just putting it on autopilot, announcing what we're going to do, and then just doing it. And then if we need to vary policy, we vary policy by either accelerating or slowing down the rise in the Fed funds rate.
The forces pushing inflation higher are many: monetary policy, fiscal policy, COVID, the supply chain snarl. But on that account, if part of the effort is to reduce demand, but supply chain is making stuff scarce, for lack of a better economic term, do you have to raise rates even higher because there's simply not as much stuff to buy?
No, I think we just have to be a little careful about that. We are starting to see signs of some healing in the supply chain. And so I think we need to move up to neutral. And with the reduction in our balance sheet, we'll be slightly above neutral. Exactly how much, we don't know. That should cool off the market. We're already seeing it. We're seeing it with the 30-year mortgage rates. We're starting to see some signs of housing starting to slow down. That's what we want. But we don't want to go into recession. And at this point, that is not my forecast that we would enter recession.
We're seeing, obviously, a lot of pressure on wages. Restaurants, Walmart saying that the trucker salary is going up to $110,000. We're seeing a little bit of signs of life almost in the union movement. How do you look at wages?
So they are increasing, but they're not keeping up with inflation. We see that, particularly for the low to moderate income folks who are out there working. The inflation's really eating into any increases they receive. So as a result, I don't expect we're going to go into a major wage price spiral. That is not our modal forecast right now, because we're also seeing some increase in productivity. And that's a good sign. That's what we want to see in the economy. So this needs to play out. We're not exactly sure. I can't say exactly where this is all going to land. That's where I think we need to be aggressive in the sense that we need to take some action, but not overly aggressive. We also need to read the data month by month.
So I want to pivot to an interesting op-ed that you've just written for Barron's, where you suggest that the Federal Housing Authority ought to be able to extend loan modifications by 40 years from 30. It sounds technical, but you say it could really help the situation.
Yeah, I mean, ultimately what we want is we want people to stay in their homes, have a place to live, particularly for those who are struggling, and also for the financial system, the banks, to not lose that much money in the process. So there's a variety of ways of thinking about this. One such way, which HUD has proposed, they put out a proposed rule in the Federal Register on April 1st. And so it is out there for a 60-day comment period. And that does propose a 40-year mortgage modification. We think that has real benefit through the work we've been doing. Right now, about 1 million mortgages are seriously delinquent. Half are in loan modification, half are not. And those people who are not in loan modification, they need some help. And I think there's a win-win potential here for the banking system and for those people so they can stay in their homes. And the silver lining of prices going up so quickly is we've got many fewer people underwater, maybe not at all. Yeah, we got $10 trillion of tappable equity right now as a record in the housing market. Well, that's powerful. Pat, thanks so much for your time. Appreciate it. Thanks, Jack.